Is there an investment strategy that can beat FD returns but with very minimal risk and very less volatility? Yes, there is one strategy and I'm going to show you that in this video. Now, NRIs being NRI have huge amounts of money parked in their NRI fixed deposits, absolutely because they are tax free. But this is a common question that I get from most of the NRIs is, Alok, is there any way wherein I can redirect these money from my fixed deposits into something which can give me slightly better return than fixed deposits, but also I don't get exposed to too much risk? Well, yes, there is a strategy that you can follow which can provide you the same, and I'm going to cover the exact same thing in this video. I show you how we have built a model which can give you consistent returns, consistently positive returns over last 15 years. And if you follow the same strategy, you are most likely to beat your FD returns with very, very less volatility. Let me show you how. See, now to understand our investment strategy, you need to first understand how does investments work and what is asset classes. Now, whenever we look at any investments, we try to distribute them into right asset classes. Broad financial assets can be something like Indian stock market equity. Then you have gold as an investment, which is always a hedge against inflation. Then you had debt or fixed income related instruments like your fixed deposits, bonds, debt mutual funds, those investments which give you very stable and predictable returns. And then there's another class that we like to qualify as foreign equity. That means diversifying into equities of various other countries. When you are allocating your money amongst these asset classes, the main thing that you need to know is that they are not always positively correlated. Now, how do these asset classes perform? This is directly dependent on which kind of cycle is right now happening in the market. So for example, when there is something like a slowdown happening, gold and just holding on to cash is something that outperforms. If there is a recessionary environment, in that case, bonds, fixed income products, these are some things that outperform. If there is a recovery in the market, then equity start performing like post-COVID situation. And then when there is a boom in the market, along with equities, prices of gold, oil, everything shoots up. Now, depending on today's situation, you can predict which kind of situation we are, but I don't want to get into that kind of details. Now, if you see this chart, you will understand that why diversification is important. If you see, for every specific year, a different type of asset class has performed in terms of returns, and a different asset class has been on the bottom side of returns. If you see in 2013, Nasdaq and US markets gave better returns, Indian market gave very less. Immediately in 2014, Indian markets gave 32% return as compared to Nasdaq, which only gave 17%, and gold fell almost 8%. And if you see, gold fell consecutively for 2 years, right? Similarly, some years Indian equity didn't do well, some year real estate didn't do well, some year debt or fixed income didn't do well. So this is how the market cycles work, and that is the reason for your right diversified investments, you need to have investments into all these asset classes to protect your downside. Now, why am I showing you this? The reason you need to see this is how your investment trajectory will be if you are invested for any long-term time horizon, let's say 15 or 20 years. If you see time from 2006 to 2024, there have been sections where equity has given almost 50% return, gold has given 18, debt, fixed income, FDs have given 6.7, right? Similarly, if you see equity from a patch of 2008 to 2013 has given literally zero returns. That is from the recession period of 2008 till 2013, equity returns are zero. Gold returns in rupees is 21%, gold returns in dollar is 9.5%, and fixed income has given slightly higher returns than the previous section. Again, if you see the next section, equity does well, gold does negative, debt does better, right? So all these asset classes are inversely or slightly correlated with each other, but it completely depends on which kind of market cycle you're participating into. So any investor will have to go through these volatilities with their financial asset investment. Now coming to the point wherein which strategy should we follow to be able to get better returns and also reduce your volatility. Now for that, if you see, let's do a combination of investments, right? Let's say you are somebody who has 100% money into FDs and bonds and 0% money into equity. Your returns would be somewhere around 7.1%, and the volatility, which is the risk that we measure with any financial asset investment, is only 6.8%. Now, if a 100% bond or FD investment has volatility of 6.8%, Can I maintain the same volatility and get slightly better returns? Absolutely yes. If you see the case where 75% of the money is into debt and 25% of the money is into equity, you still maintain the same volatility, which is 6.9%, but you get slightly higher returns, which is 9.8%. Isn't that good, right? Just by diversifying your investments in some right manner or right proportion, you can beat your FD returns and also maintain the same kind of volatility. Now, one might ask, Alok, how is there volatility in fixed deposit? Absolutely, there is. The fixed deposit rates keep on changing every year. So one year you are getting 7%, other year you are getting 7.2, the next third year you are getting 6.5. So this is also a volatility, and that is the volatility that we are measuring, which means your rate of return can vary by 6.8% to 7% in any situation. If I start increasing the equity percentage in your investments, the volatility increases, but that is what we don't want. The current objective of our strategy is to maintain the same volatility as a fixed deposit, but can we try to enhance our return? Now let's again put a twist to this. What if along with equity and debt, I include something like gold also, right? So if you see, there's a portfolio where you have 80% money into FD, 20% money into gold. Now this portfolio gives you only 6.5% volatility. But if you change your allocations in such a way that debt has 55%, 20% in gold, and remaining 25 stays in equity, the volatility almost remains the same. But the main thing that you need to notice is instead of 8.5% returns, you end up making 11.2% return, right? So your volatility, your movement, your portfolio changes remains the same, but you end up making higher returns, right? So this is something which we have not only backtested from a lot of years, but we also follow this meticulously for our clients who are very risk averse and who don't want high volatility, high risk in their portfolios. Let me show you what happens on a longer time horizon. So this is a chart for last 15 years. Now, if you see, we have come up with a proportion wherein any given moment, we would want to invest 25% money only into equities and stock market, not more than 25% into Indian markets. We put another 5% into US markets to get diversification in equity. 45%, which is major part of our investments, goes into debt, fixed income bonds, and the remaining 25% goes into gold. Now, this allocation, if you see, for year 2011, equity market gave 12%, bonds gave 5%, gold gave 7%, and US markets gave 14%. So the weighted average of this portfolio is somewhere around 13%, right? In the second year, the same portfolio will give you 10% return. Some part of the portfolio will fall, some part will gain high, but eventually you end up making positive returns that year. Similarly, 2013 is a positive return, high returns. There's only 2 years, which is 2016 and 2020, where the returns you can see are slightly lesser, right? But that can also be managed with right allocation and changing the allocation. But if you are somebody to keep the allocation same, you will still beat FDs by big margins every year. There have been years where you will make 12%, 20% returns also, and there will be years where you will make 8%, 6% returns. And that is what I'm trying to convey from this video. Every year you are making positive returns, right? Irrespective of there's a war happening, markets getting corrected, rupee getting depreciated, all of that included into that. If you see, your annualized average return comes down to around 10.7%, which is almost 3 to 4% of what your fixed deposit is giving you by taking very, very, very less risk and having the same volatility that a fixed deposit or a bond investment will have. To conclude this video, please make sure that your investment is rightly diversified. You do this asset allocation and the changes in the proportion rightly. Why do you need to do that? So that your asset classes are rightly diversified and you get better risk adjusted return on your investments. Also, maybe we can do a separate video on this, that what are tax implications, because if you have 100% money into bonds and FDs, you end up paying slightly higher taxes. But if you have your money into a diversified portfolio, you can actually end up saving a lot of money on taxes also. So how do you need to do this? Decide your equity allocation first, depending on valuation. Then how much do you put into foreign equity, gold, FDs, and then always keep on rebalancing this. Now you will ask, Alok, this is something which is hard to do, and how can we do this actively? You first of all don't need to do this actively. There are right investment products, right mutual funds who can do this for you. So if you invest 100 rupees with these mutual funds, they will be the guys doing this allocation changes for you and generating better returns than FD for you, keeping your risk and volatility very minimal. Now, which funds these are? I would not want to comment on these videos because this is part of the financial advice, and I am not somebody who is ready to give financial advice for free, because this advice has to be given by rightly analyzing and understanding your financial situation. So if you are somebody who has a lot of money into fixed deposits, is okay investing some part of it into an investment that can give slightly higher returns with very minimal risk, please reach out to me and I'll be more than happy to help you. If you like this video, please subscribe to my channel and join our NRI only WhatsApp community, for which the link is in the description below. Thank you, and I'll see you in the next.